Now we know we can do velocity banking with our credit cards, but did you know you can also do it with a home equity line of credit or a HELOC? Let's go over how to do it with the HELOC first, and then I'll show you what it would look like with the credit cards, and you can also combine the two. So they have a home equity line. The current balance is $36,665. Their minimum monthly payment is $350. When we do velocity banking like this, we are eliminating this $350 payment out of their budget. So if we're doing velocity banking with a HELOC, we take our entire paycheck and pay it to the line of credit. They get paid on the 4th, so this is the paycheck of the 4th. Then all of the other bills and spending are going to be paid with the HELOC. So all of these other bills here, and we also have their food, which is about $250 per week. Their gas was about $35 per week, and their miscellaneous spending, if we cut $300 out of this, was about $350 per week. So that is all included here, and actually I forgot to add the miscellaneous spending, so I put 2 of them on the next week. So the paycheck on the 11th, again, we go in, we pay all of it to the home equity line. Then we use the home equity line to pay for the car payment here. You can use your home equity line of credit like a bank account because it has an account and a routing number. So you can pay your car payment with your home equity line of credit. You can pay your mortgage with the home equity line of credit. Those are things that we typically would call cash expenses if we're doing velocity banking with our credit cards, because those things we cannot pay with our credit cards. But if we're using the HELOC, we can. For the food, the gas, the miscellaneous spending, you could go take that amount out in cash every week, right out of your home equity line. So again, we paid all of the bills and spending with the equity line. So we see where the balance started. It goes down. We put the bills and spending, it goes up. We pay, it goes back down. We do the bills and spending, it goes back up. But slowly, each time we do this, the total amount that we owe is getting less. So same thing on the 18th, we would pay the entire paycheck to the home equity line. With these first 3 paychecks, we've already paid 2 for at least $6,000 to the home equity line. So our minimum payment of $350, we no longer have to make, because we already paid over that amount. So the paycheck of the 18th, we don't have to pay the equity line anymore. We've already paid the money into it. Then we go back in, pay for those other bills and expenses. The balance goes back up again. The last paycheck of the month, same thing. We go in, pay it all to the equity line, and then we pay all of the expenses with that line of credit. Now you might look at this and say the amount of bills and spending was more than what we paid. That can happen sometimes, but look at how much we paid here. And we were only $200 short here. So that balance still went down for the month. Now this is without calculating the interest. We started at $36,665. After we paid all the expenses for the entire month, one whole month, the balance is now down to $35,478. So the balance is down around $1,200. Let's say they take out $300 for your interest charge. You still paid about $900 down on that balance. This is one of the easier ways to do velocity banking if you have a HELOC available that you can use. But of course, there are downsides to any way that we decide to do things. This is not going to increase your credit score as fast because we're not focusing on credit cards. So if credit score is something that's important to you, I would either do it with the credit cards or both the home equity line and the credit cards. It is good that we have all of our money going into one account, all of our bills coming out of one account. It makes it easier. The only problem with doing velocity banking on one account alone is they can lower your credit limit. So we know this can happen with credit cards. If we pay a lot to a credit card, they may lower the limit on us. Same thing with a home equity line of credit. They can stop our spending at any time without warning. So just something to be careful of. If you wanted to eliminate the $350 monthly payment, you could pay enough to just pay your mortgage out of your HELOC and then do everything else on the credit cards. Now, if we don't care about our credit score and we're only doing this with the home equity line, we're not using our credit cards. So all those minimum payments that we're making to the credit cards, the balances are going to go down. So remember, we pay the paycheck into the home equity line. Then we use the home equity line to make the credit card minimum payments. And if we're not using those credit cards to pay for other expenses because we're using the home equity line, the balances on the cards go down. Now, obviously we want to make more than the minimum payments, but even just making the minimum payments, your balances should be going down slightly. You can do it with the equity line and with the credit cards. If you're doing it with the credit cards and the home equity line, you would pay majority of this money here to the credit cards. And then you would use the credit cards to pay some of these bills. I know that may be a little bit confusing to talk about doing both. Maybe after I go over the credit cards, it'll make a little bit more sense. But if we're doing velocity banking on a home equity line of credit only, we put all of our income into the line of credit. We pay all of our expenses out of the line of credit. We put all of our income in, all the expenses out. The line of credit balance will go down. And it's still important to make sure you plan for your miscellaneous spending things here. This is a lot of times where we go over in the budget. With their savings, they do have a small amount put up right now. So the numbers that I used here were without anything going into savings, but we're paying the equity line down faster. If you do want to continue saving a small amount, I would probably cut it in half and just do $200 a month for now until we see some of the balances, at least on the credit cards, getting lower every month. So to summarize, the HELOC is a little bit easier if we have access to one, but it's still the fact that we're using one account that does scare me just a little bit. Now let's look at what it would look like with the credit cards only. They have quite a few credit cards. What I would do is pick a couple that you're going to use. So these few cards here would be the ones that I would use because of how they're spaced out and their statement dates close throughout the month. All of these other cards, we do not do any spending back on those. So every time we make a payment to one of these other cards, the balances are going to go down. If you pay $20 extra to a credit card, it might not feel like you're making any progress. But if we're paying $20 to each one, obviously that number is going to be a lot larger, which is why it's super important to track the balances of your debts. Not only tracking the balances of your credit card debts, but also any loans that you have. Anytime you make a car payment, go in whenever that statement closes and see what the difference was between last month and this month. Your balance has gone down some. They have 2 car payments. Both of those are going down. Every time we make a payment to the windows, those are going down. If we're not using the HELOC, that balance is going down. So very, very important to track the balances of your debts. So the way I have this written, we're not using the majority of these credit cards. I have the stars next to the cards that we had planned to use. So if we look at the first paycheck on April 4th, we get $2,000. We have $440 in cash expenses, which was the life insurance and the car payment. That leaves $1,560 that we can pay to the credit cards. We always have to plan what expenses are going back on each card. So the first bill that we have due at the beginning of the month is the internet. So we'll have to use the card that had a statement date at the end of the month, which in this case would be the Apple Card. The Apple Card due date and statement date are the same. It's the last day of the month. Then they don't have a whole lot of other expenses coming out through the month. But remember, we also have the food and the gas and the miscellaneous spending. The miscellaneous spending would be $350 per week. The food would be about $250 per week, and the gas would be about $35. So as soon as we get the paycheck on the 4th, we have the Barclay card that's due. Its minimum payment is $280. This is another reason why I said we would use this card for Velocity Banking to eliminate this $280 monthly payment. So with that card, I would pay the water, both medical bills, the food, the gas, and then their gas bill, which all of those things aren't due until later in the month. But that's okay. They probably have more money to pay down debt in the beginning of the month. That's what we're going to do. Then during that paycheck, we're also going to use the Capital One card. That is this card right here. We're going to use the Capital One for the electric and the miscellaneous spending of $350. Another thing we need to pay attention to when we're paying the cards to use them is the amount that we're going to be charged in interest. So we have to pay the total for the bills plus enough to cover interest plus a little bit extra if we want the balances to go down. The bills and interest on this card are probably about $850. So we're going to pay $900 to that card. So we round it up a little bit. That balance should go down around $50. The Capital One, we needed to pay about $550 for these 2 bills plus interest. So we ended up paying about $700. So that balance would go down about $150. Now all of these other cards here were cards we were not going to use. What I did was look at the minimum monthly payment and round up a small amount, like $15 to $25. So the Kohl's card, the minimum is $43. We paid $60. So that balance will probably only go down around $25, but still, we have a bunch of other cards where those balances are also going to be going down a small amount. Again, super important to track the balances of all of your debts. Lowe's, we only rounded up $9. That's okay. You just want to pay a little bit over the minimum if we have a lot of cards like this. The Huntington, we rounded up 15. The Capital One, we rounded up 25. So that's kind of how I look at it. You just have to make sure you have enough to pay extra to those. Let's look at the second paycheck. On April 11th, we get $2,330. We have $350 in cash expenses, which I had as the car payment and then $100 for their savings. Remember, I had lowered this down to $200. This leaves $1,980 that we can pay to the credit cards. We only have one credit card here that we're going to use to pay bills. The rest of them, I did the same thing that I did over here, just round up a small amount. Now the Capital One card that we need to use, we have to pay probably around $1,050 to cover all of these bills plus the interest. So we paid $1,200. So that balance will probably go down around $150. Now this Capital One card that we're talking about was due on the 14th. Again, it has a larger monthly payment, was another reason that I used this card for velocity banking. But this credit card statement date is also after this payday. That's another thing you have to pay attention to. You could make another payment to that card on the next payday because that statement doesn't close until the following day. Sometimes if you need to, that's something to look at as well. In this case, we don't need to do that because we already had enough to pay to the card. Now the paycheck on April 18th, we get $2,000. We take out the cash expenses. The cash expenses were the HELOC. Remember, this is if we're not using the HELOC like we talked about earlier. So we have the HELOC and the windows. This leaves $1,510. We have multiple cards here that we're not using. This card was paid off, so it doesn't have a minimum payment. Then if we look at the Huntington card, we have the trash, the car insurance, the food, the gas, and miscellaneous spending. Remember with the miscellaneous spending, we had $1,700 for the month. We were gonna try to cut $300 out of that, which would leave us $1,400. If we divide that by 4, that's $350 going on 4 cards. So we have $350, $350, $350, and $350. So we use these 4 cards for miscellaneous spending, not this one. Now with the Huntington card, we need $855 plus interest probably of about $200. So we need $1,050 paid to this card in order to put these bills back on there. And I actually didn't put enough down here because we miscalculated. So we might have to steal $100 from over here. So that would pay $1,100, which would pay about $50 over after interest. So the balance should go down around $50. Now the paycheck on April 25th, $2,330. We go in, pay the cash expenses, which in this case is the savings, but we also have to look forward to the next week because the mortgage is going to be due again at the beginning of the month before the next paycheck. So we have the savings of $100 and the mortgage. So we have $1,160 coming out of the check on the 25th, which leaves $1,170 to pay to the cards. Same thing here with these 4 cards that we're not using. I just rounded up a small amount. The Apple card was a card that we were going to use. I would use the Apple card for the internet, the food, the gas, and the miscellaneous spending. We need to pay about $770 to cover the bills and the interest. So after I stole $100 here to put with the Huntington, we're paying $780 to that card. So just a very small amount over what we had. But this is how it can look, especially if you have a lot of credit cards that you're trying to pay down. If you have a long list, pick a couple that you're going to use and pay a small amount extra to all of the others. Again, tracking the balances of all of those credit card debts every month is so important. That's how you're going to see progress. You're going to see your total overall debt going down. You'll see your net worth going up. I use a spreadsheet for this. It simply lists every single debt that I have, whether it's a credit card, a loan, a medical bill, it doesn't matter. They're all listed. Every month I go in and I put the new balance. Then every month after that, I make sure that the balance is getting less and less. So again, a HELOC might be a little bit easier for you to do velocity banking. Or if you're really focused on your credit score, you might want to try to do it with your credit cards. Once you get a couple months into this, it's going to start making more sense, and then you might be able to combine the 2 methods. But make sure all of your balances are going down. Make sure you're not spending more than what you had planned back on the credit cards. That's one of the biggest problems with this method. You have to plan what's going to be spent on the cards, and you have to stick with what you said you were going to spend. Otherwise, the balances are just going to go right back up. You're still going to feel like you have no money left over. If you're tracking the balances, they're not going to be going down. You have to stick to what you planned. But I do like both options here, each for different reasons. And as always, let me know if you have questions about anything that we mentioned here.